the stock of Signet Jewelers run. This morning, the parent company of K Sales and Jared put up a robust quarter in a very difficult environment. Stock shot up nearly 14% in response. That's a huge run, considering that even though Signet delivered a solid earnings beat, its full-year forecast came in a little light. But they've cleaned up the balance sheet, managed to generate a huge amount of cash flow, $525 million. That's up 20% year over year. That was enough to get buyers very excited. Even though the stock's up 58% over the past 12 months, I think it's not getting full credit. But don't take it from me. Let's check in with J.K. Symancyk. He's the CEO of Signet Jewelers. Mr. Symancyk, welcome back to Mad Money.
Yeah, thanks for having me, Jim. Glad to be with you.
Well, I got to tell you, J.K., I've never seen the whole fleet do so well. Everything's working. I know you credit the team, and that is fantastic. But what is it? Is it price? The consumer recognizes some value? Is it just the assortment? Because this is a monumental quarter for Signet.
Well, I appreciate it. I do think it starts with the team. I mean, we've digested a lot of change. You pointed it out in the intro. It's not an easy environment. I think a simplified operating model really does help clarify accountability and allows us to leverage scale. And truly, our focus on our core brands is a critical part of the success story. K, Zales, Jared represent over 70% of our revenue, and it's just like, it's just like us as humans. If the core is healthy, then the rest of the business works better. And I think that outsized focus and really operating from the core is a key to driving strength across our business.
Well, I'm glad you did it. I mean, you went from 8 to 4. It's really hard in any business to run even 4. Things got a little bit too spread out, didn't they?
Well, I think it's, we've grown a lot. I think we've picked up a lot of capabilities through some of those acquisitions over the years. But I think the ability to really focus it through a consumer lens to think about, something that isn't 8 independent businesses that are operating and maybe stepping on each other to a core of 4 engines within the portfolio that are really driving value. I think helps us not only leverage scale and cost, but it actually helps us with consumer focus so much more.
Well, if you have consumer focus, I think that you're drilling down on all different consumers now. A lot of people keep telling me, look, the consumer's not doing well. You have some pricey merchandise, so to speak. It seems like everything was selling well.
Yeah, I think for the most part, the business worked well. Now, Q4, it's not news. We started a little slower, and I think November, with all of the consumer malaise that a lot of my peers have talked about, we certainly weren't immune to it. I think we felt that a little more on the lower and the middle end. But, I love that we've got a portfolio that speaks to the full, cross-section of incomes across the consumer landscape. It gives us lots of room to flex our business and grow. And certainly we saw that consumer respond. We've seen that momentum carry into Q1. We're halfway through the quarter, and we've seen growth across all income bands.
But what I love is that Valentine's Day was good. I find that from my father who sold gift wrap. If you can have a good Valentine's Day, that is an amazing thing, because your first quarter tends to be dry versus the fourth. It means that the consumer got reliquefied or has a lot more money than we thought.
Yeah, I think we've seen it. I mean, we've seen a resilient consumer. In our category, I still think average unit retail is a little more of the growth story, although, maybe different than what we saw in Q4. Units are much more balanced. So when we look at our business quarter to date, I would actually call it much more even across income bands, balance between bridal and engagement, and a good mix of some average unit retail expansion, but also some modest improvement in unit performance.
Yeah, J.K., there was this kind of a big movement to do lab grown. All right, that makes sense. And then people start saying, well, lab grown don't hold the value. You got to have the real diamonds. And now I'm told by the more fashion plate oriented that this lab grown has really exploded, particularly because of the gold bands, that it's become much more fashionable than it was a year ago.
Diamonds, both lab grown and natural diamonds are critical. And I would say they're pretty balanced in terms of opportunity across the business. Lab-grown diamond fashion growth, I think, is higher because there's an affordability and accessibility, Jim, that wasn't there before with natural diamond for your lower and middle income consumers. And so, the penetration of that grew to 20% of our total fashion penetration in Q4. That's because there wasn't much center stone business there. On the engagement side, we still see customers that seek the beauty and the rarity of a natural diamond, and they'll navigate probably more according to what price point their budget is. But the aspirational side of it, we still see opportunity for growth in natural diamonds as well, and they're both unique propositions for our business and important for growth for our future.
All right, now, one of the things I think is really exciting about your company is now that you're out of the buying these different things, and they were all good things and put together will be fine. The amount of cash here, I did not know you could generate this amount of cash flow. I found myself thinking, if I were J.K., what would I be doing? You don't want to buy back too much stock, but the stock, why not? The stock is very cheap versus what it could be. We all want a dividend. But the fact is the balance sheet is so much better than it was even 5 years ago. What are you going to do?
Yeah, I think I appreciate the recognition for it. I think our team's worked hard to strengthen the balance sheet. Our CFO and our finance team have really driven discipline across the business. And I feel we're fortunate to be in that position. We really are balancing the choice between the opportunity to return capital to shareholders via buyback, or where are the opportunities to invest in organic growth. This year, we know we've got an opportunity as it relates to customer experience. And I would say the two critical investments for us, first is digital. Our website experience, front-end experience, I'm not talking about back-end platform, but how we interact and communicate with customers, has not changed since 2019. Suffice to say that the consumer has evolved in that time period. And so the fact that we're still seeing growth in traffic to our sites and we're seeing improved resonance with our customers, I know that if we can make the investment to deliver a better brand experience there, it's going to help unlock more value for us. Same is true in our stores. We're increasing our investment in store environment 30% more stores touched this year than we did last year. We're seeing outsized returns, particularly in the brands we're further along. And so we'll continue to balance that investment, looking for ways to return capital to shareholders, but also leaning into those opportunities for organic growth that we think will make a difference for tomorrow.
That'd be great. You get that top of the funnel going with the digital. You get even more assortment, but within the 4 rather than 8. And then you give us maybe some more buyback and dividend. This stock is one of the things we're going to be thinking about as a great retailer. We'll be buying it not as a special situation, which is what it's been, but as a great retailer. J.K. Symancyk is the CEO of Signet Jewelers. This is a different company from the way it was. Congratulations.
Thank you. Thank you, Joe. Appreciate it.
Mad Money will be back after the break.